This point, with the market up where it is, it seems as if after this week's CPI report, it almost seems like consensus. Where does that take us in terms of what the market has already priced in?
Yeah, and I think one of the interesting things is that if we look into 23, the rest of the year, and 24, what you already are pricing into earnings is that soft landing. You have a growth of about 11% of earnings in 2024. So it's a question of what do you pay for that, and is there any further upside to those earnings? And that's where we look at markets trading at these very high valuations. And now we see positioning, which did start the year incredibly short, incredibly light and underweight, has now moved about 75% of the way back to kind of an overweight position. So that's what we'll watch to see what's the next leg higher for this market. How much more do you get people drawn in? There's no doubt about that. I mean, we've seen an ongoing kind of short squeeze running through parts of this market. The heavily shorted stocks have been soaring. And yes, the positioning numbers, the sentiment data, probably less of a tailwind certainly than it was. I just wonder if we can exist in that comfortable place for a while. I mean, because the market, when it's in an uptrend, you know, when it seems like the economy is in a decent spot, it doesn't always punish optimism right away. Well, exactly. What you see is that valuations can go high and stay high. Yeah. Sentiment can go extended and stay extended. And I think the real measure is going to be, do earnings continue to surprise to the upside and deliver on that optimism? For the second quarter, we actually think that earnings estimates are too low. If you look just at the revenue line, the forecast is for revenues to be down about 0.5%. But you compare that to nominal GDP, and remember, revenues are a nominal number, we're tracking closer to 6%. So that's a pretty big gap on value on the estimates for even just the top line, which is why we think you could see more beats this quarter. So we have the formal consensus estimates, as you cite. Yeah. You have what the market has already kind of priced to some degree in advance, and you have the actual investor expectations for how much companies are going to beat by. So we look for clues in earnings reactions, right? So what do you see? It's early. We've only got a few of the banks and a handful of other companies, but so far, you've seen some selling into the good news. Yeah, it is disappointing with the banks given this setup, because we know that so many of them were trading at depressed valuations, some below book value, which indicates that there was some distress priced in. Positioning was light, expectations were low. They come out, they beat, they raise, they talk about some cautious optimism. There's some mixed signals, and yet they give up all of that strength. It's not to say that they can't find their footing, but if this is an economy that's much better than expected, growth holding up better than expected, we really would like the banks to participate in that as a sign of health for the underlying market. Right. I mean, you like to see it as a market signal, but also the valuations don't make a tremendous amount of sense for banks if the rest of the market is somewhat correct. Exactly. About the economy. Yeah. Exactly. And then if we look at broader sectors, other sectors should be showing more positivity if this is a stronger economy. Think of things like energy, which has been in the doldrums because oil prices have been weak, somewhat pricing in the risk of recession. If you look at materials, that has been weak because of weak manufacturing. If you start seeing those things start to turn around, you should see that broader participation, kind of what you would call those cyclical value parts of the market. Well, we have seen, in general, more stocks participate, right? So since Memorial Day, let's say, S&P's up like 8%. The average stock, or the equal-weighted version of the S&P, has outperformed over that span. So essentially, June and month to date, it's been better. Now, the big stuff has still worked, right? That's the other interesting part. It hasn't been a zero-sum game, but I guess has it been enough to really get traction in terms of the strength of the tape and proof that demand is going to be strong for stocks on an ongoing basis? It is an important point that strength in other places has not yet come at the expense of the prior leadership. Now, we have seen this big divergence in flows where you've had huge flows into tech and very big outflows, kind of capitulation in things like energy. Does that start to close because you're at those positioning extremes? And then it's a question of, can the cheaper valuation in the equal weight index or the value index be enough for those parts of the market to work better? The trends in those areas from a technical perspective still remain somewhat weak, but if we look out over the next 2 years, we'd rather buy things trading kind of below their long run average valuations instead of things like growth and tech names, which are now all the way back up to their prior peaks and valuations. Right. As the NASDAQ 100, I think, is like 5 or 6%, even in price below.
below its peak. If the market at some point, needs a breather and goes in search of something to worry about, which sometimes does happen at these stages, what do you think is more likely to be that gut check? Is it going to be faltering growth and we have another recession scare? Or is it going to be, yields have some upside because inflation is sticky and we have to reprice the Fed again? How would you see it?
I think both of those are very much wild cards. And when we think about the inflation side of things, we do see it continuing to moderate. But we have to remember this will be a market that will remain hypersensitive to incoming inflation data, just because of the past experience that we've had, and that the Fed is going to be hypersensitive to it. So if you have a couple months of a re-acceleration of inflation, that could be enough to shake the market, just given the fact that you are trading at such high valuations. Doesn't necessarily have to completely throw the rally off of its course, but could be a cause for pause.
Sure.